Hey everyone, welcome back to Finance Friday. It's another special edition of Money Girl where I answer your burning money questions. Today's topic comes from Sharon, who says, I'm 60 years old and self-employed in real estate. I have over $750,000 in my IRA, which is invested in stock and bond mutual funds. But I also have $60,000 in credit card debt that's weighing on me. The cards help me stay afloat during a 2-year downtime. Should I dip into my IRA to pay off my credit cards? Thank you for your question, Sharon. I know being self-employed can feel like a financial roller coaster at times. Dealing with a 2-year downturn in your business is tough, there's no doubt. And using credit cards certainly can be a lifeline in dire situations. That weight of the debt that you talked about and that you're feeling is real. So I'm glad that you reached out for help. This podcast will review the pros and cons of tapping an individual retirement account or IRA before and after the official retirement age of 59 and a half. Plus, I'll discuss other options for Sharon to pay off credit cards. Welcome back to episode 969 of Money Girl. I really appreciate you downloading the show, spending some time with me. If you're new here, I'm Laura Adams, an award-winning author, on-camera spokesperson, money speaker, and founder of The Money Stack. That's my Substack newsletter, and I'd love for you to subscribe. You can learn more, ask a money question, and sign up for the free Money Stack newsletter when you visit lauradadams.com. Or you can become a paid member of the Money Stack and get access to my live educational and Q&A events. Additionally, you can ask a money question by leaving a voicemail by calling 302-364-0308. I'd love to hear from you and feature your question here. All right, so let's talk about the traditional IRA withdrawal rules. So before you or Sharon dip into your traditional IRA, it is essential to understand the withdrawal rules. In general, a withdrawal before age 59 and a half is considered an early distribution. So that means any amount that was not previously taxed would be subject to income tax plus an additional 10% penalty, unless an exception applies. And I'll give you some examples of the exceptions here. This is not a complete list, but it is available for those in the military. Certain distributions to qualified military reservists called to active duty are not subject to a 10% early withdrawal. Or if you're a home buyer, if you're a qualified first-time home buyer, you can withdraw up to $10,000 for buying or building a home, and that amount is not subject to the 10% penalty. It also applies for medical expenses. If you withdraw to pay unreimbursed medical expenses that exceed 7.5% of your adjusted gross income, it's not subject to the 10% penalty. Also, for medical premiums, if you're unemployed, you can make withdrawals to pay health insurance premiums without paying the 10% penalty. Also, for disaster recovery, if you have an economic loss due to a federally declared disaster where you live, up to $22,000 that you withdraw is not subject to the 10% penalty. Also, something new is if you are a domestic abuse victim. If you're the victim by a spouse or a domestic partner, up to the lesser of $10,000 or 50% of your account is not subject to that 10% early withdrawal penalty. Birth or adoption is another exception. So distributions up to $5,000 per child for qualified birth or adoption expenses are not subject to that 10% penalty. Also, education. Distributions you make for higher expenses for yourself or a dependent are not subject to the 10% penalty. And there's something new for emergency personal use. You can make one distribution per calendar year for personal or family emergency expenses up to $1,000 without being subject to the 10% penalty. And for a tax levy, if you must withdraw funds due to an IRS levy to satisfy a tax debt, they are not subject to that 10% penalty. And health insurance. Any distributions to pay for health insurance when you're unemployed for 12 weeks and receive unemployment compensation, in that situation, they're not subject to the 10% penalty. And for being disabled, if you become permanently disabled, your distributions are not subject to the 10% penalty. And death. If you die, neither your estate nor your account beneficiary is subject to the penalty. Now, I want you to note that most of these penalty exceptions only apply to IRAs, not to workplace retirement plans like a 401k or a 403b, which have different withdrawal rules. So you have a little bit more flexibility on withdrawals with an IRA. Now, since Sharon is 60, the good news is that a traditional IRA withdrawal is no longer early or subject to an additional 10% penalty. However, the consequence of tapping her traditional IRA would be paying income taxes on the distribution. For example, let's say Sharon earns $100,000 in her real estate business. If she also withdraws $60,000 from her traditional IRA, her taxable income for the year would be $160,000. So that's a substantial tax increase that she would have to be prepared to pay. Let's assume she does not have a tax-free source of income like savings or investments in a brokerage account to sell to pay those taxes. Well, in that case, she'd actually have to withdraw much more from her IRA, perhaps $80,000 or $85,000 to cover the debt and her taxes. Now, Sharon did not mention having a Roth IRA. I am assuming it's a traditional IRA. However, I do want to review the Roth IRA withdrawal rules for you. A Roth IRA is similar to a traditional IRA in many ways, except for how it's taxed. With a Roth, you make after-tax, non-deductible contributions and can make tax-free withdrawals after age 59 and a half if you've owned the account for at least 5 years. However, regardless of your age, you can withdraw original Roth contributions without paying taxes or a penalty. But withdrawing untaxed earnings from a Roth does trigger income taxes plus a 10% early withdrawal penalty if you're younger than 59 and a half. Since Sharon is 60, taking a Roth IRA withdrawal would be tax-free, assuming she's owned it for at least 5 years. So going back to my example, where she's earning $100,000 in real estate and withdraws $60,000 from a Roth IRA, in this example, Sharon's taxable income for the year would be $100,000, not $160,000. But I am going to assume that she has a traditional account. So when is it wise to use retirement funds for debt? While I understand feeling anxious about debt, Sharon should only use her IRA as a last resort, so it grows as large as possible before retirement. Her $750,000 nest egg could be her only source of lifetime income once she stops working. Every dollar you withdraw from a retirement account is a dollar plus potential growth that you won't have to spend in the future. Let's say Sharon withdraws $85,000 from a traditional IRA to net approximately $60,000 after taxes to pay off her credit card debt. If the $85,000 were left invested instead at an average return of 7%, it could nearly double in 10 years, growing to just under $170,000 by the time she's 70. It could double again by her 80th birthday, growing to about $340,000. So that's the actual future cost of this withdrawal. Another consideration is Sharon's future income. If she taps her IRA and experiences another volatile period, she could end up back in debt with even less for retirement. Now, the other side of this dilemma is that Sharon's credit cards are likely charging high interest rates, such as 20% or more. Sharon didn't specify, but paying off a debt with a 20% interest rate is a 20% guaranteed return on your money. Her IRA investments are likely earning much less, and certainly don't come with a guarantee. Also, being debt-free could help Sharon feel less stressed, and that has real value. We don't know enough about her finances, career, or her health to determine whether using her retirement to pay off credit cards is wise. Therefore, I'm going to recommend that she explore other options to pay off her cards first. So instead of tapping an IRA, I'm going to go through 6 ways to pay credit card debt that could make sense for you and Sharon. Number 1 is budgeting. This is just cutting unnecessary expenses radically for a period so you have more money to send to credit cards. If Sharon is having a good year with more income, she should live on a bare bones budget and send as much as possible to her cards. So if you haven't already scrutinized your expenses, there may be categories that you can reduce, giving you more financial breathing room. Alternately, you may have options to increase your income with a higher paying job, a second job, or a temporary or permanent side hustle. Number 2 is using a balance transfer credit card with a low or no interest promotional period. That allows you to reduce or even eliminate your interest expense temporarily. Even if Sharon could transfer $10,000 or $20,000 to a 0% card, the savings could help her. This strategy is most effective when you can pay off the balance interest-free before the promotion expires. Number 3. Getting a home equity line of credit, or HELOC. That may allow you to pay off higher rate debt with a relatively low interest rate loan or line of credit. Now, Sharon did not mention being a homeowner, but if she has enough home equity, tapping into it could be less expensive than using an IRA. The downside is that you could face foreclosure if you're unable to pay a loan that's secured by your home. Number 4, taking out a personal or debt consolidation loan with a relatively low interest rate, especially if you have good credit, that may reduce your interest expense. The downside is that a short repayment term, such as 3 or 5 years, results in a higher monthly payment compared to your credit card minimum payment that you must be able to afford. Number 5. Negotiating a debt settlement. This may be an option if you're about to miss a payment or are already behind. You can contact your card issuers to explain that you've experienced a hardship and negotiate a lower interest rate or even a payment plan. It can negatively affect your credit, but it may be worthwhile if your credit scores have already declined. And number 6. Obtaining nonprofit credit counseling. This can include debt solutions offered at no cost or at a low price, such as a debt management plan. It consolidates debt into a single monthly payment, often with reduced interest rates and lower fees. Counseling services, such as those offered by Money Management International, can help you understand the pros and cons of various options. Sharon might consider using a combination of these alternatives to pay off her credit cards. However, if Sharon still feels the pull to take an IRA withdrawal, perhaps she could withdraw a smaller amount, such as $20,000 or $30,000, and use her income to pay off the remaining debt balance. That would significantly reduce her tax liability. Also, if Sharon's income continues to be volatile, the timing of her IRA withdrawal matters. For instance, doing it in a low-income year means you may remain in a lower tax bracket. But taking a taxable withdrawal in a higher income year is particularly problematic because it could push her into a higher tax bracket, resulting in unnecessary tax payments. Sharon, I hope this has been helpful, and I want to thank you again for your question. I know that if you're proactive, you can absolutely take control of your debt. In future years, when your income rises, I recommend aggressively increasing your emergency savings and replenishing any IRA withdrawals to make up for lost time and money in your account. Before we go, here's a quick reminder to subscribe to The Money Stack. That's my weekly newsletter when you visit lauradadams.com. It's filled with money tips, tools, news, challenges, and things I enjoy. You can subscribe for free or upgrade to a paid membership with access to my live educational and Q&A events. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and we've got a great team working on the show. Steve Rickyberg is our audio engineer. Holly Hutchins is our director of podcast. Morgan Christensen is our advertising operations specialist. Rebecca Sebastian is our marketing publicity manager. And Nathaniel Hoops is our marketing contractor.